32%. That's the number of stocks that are currently outperforming the S&P 500 over the last 20-day average. And you know what? It's not good for us investors and retail traders out there because in the past, it's shown us weakness. Hello, ladies and gentlemen, and welcome back to the Daily Show where we talk about stocks, commodities, and cryptos. We'll be exploring all the way back to the 1920s of when this has occurred and uniquely looking at 1999 to try to better understand whether this is something we should be concerned about right now. But to make matters even bigger, we have third week options expiration coming up, which is in the trillions of dollars, and also it's Tesla earnings. We just saw the announcement and markets are not liking it. Let's discuss all of this and more today. See you soon. Well, welcome back, everyone, to the Daily Show where we discuss markets around the world. If it's your first time here, welcome to the show. It's a great community, so consider subscribing and smash that like button. We'll begin with the news, the macro, the lead indicators, and of course, the hottest chart levels you need to be watching, including crypto, which is making some big moves right now. Let's discuss Tesla stock, though. It fell over 5% in after hours, and basically it's because of demand destruction in some ways. Price margins are falling to try to keep, of course, many cars on the road. And this is a big thing, I think, about getting a huge installed fleet. Obviously, Elon Musk talked about this. He said, we are taking the view that we want to keep making as many cars as we can. The market doesn't care anymore, though, unfortunately for the market or for Tesla holders. You have to kind of put up good numbers right now. Fundamentals are starting to take over. And yeah, it's a bit of a hiccup. And we'll look at it later on in the stock price when we start to think about whether we'll actually eventually get that 145 gap fill that we've been discussing for quite some time. Let's now go back a little step here, though, and talk about markets coming into a recessionary period. Now, we probably know a recession's coming. The bond markets told us that. The Feds basically told us that. Now the question is it mild, is it hard, or is it medium? We don't really know yet. But what is currently happening is money market fund assets are still increasing. Now, we've seen this tend to be a bit of a sign that markets are bottomed. When we see bonds and money markets start to decline, it's usually meant that we've got a bottoming of the market overall. And I think that's something that's very important to ascertain. Yes, it is still rising and people are still freaking out ahead of whatever comes this way in markets over the next couple of months. We also do know that we're still getting a lot of confusion from the Federal Reserve, which is expected to raise 25 basis points coming up in their new meeting and then hold. Remember, they're telling us they're going to hold based on the dot plot their rates for longer. Now, the market itself is expecting a lot of cuts. This is where we're getting a huge disagreement, and we've seen it come through in the last couple of days as yields have rebalanced up, which is an expectation we have had on this channel for a little while. Let's now go into some of the lead indicators. Fear and greed index, of course, we know here that greed is starting to take over. 68 readings fairly high. When we see this, we need to be cautious if we are, of course, bulls. And more importantly than that, over on Twitter, I posted, we finally hit a level that, we've been waiting for quite some time. The VIX spiked in the previous session, then fell and compressed all the way back down, all the way under where it all began in 2022. So basically, we now have a 2-year low reading on the VIX, which says that fear has effectively left the building and greed has fully taken over. Let's now talk about the data and the stats. And we've got 3 massive kind of numbers coming your way as we go through this. The first one has to do with components of the S&P 500 and correlation. Now, we've seen an increase in price, yet less components are going up. This is not new to people that have viewed this channel. We've talked about breadth and this kind of thing a few times. But what is new is how little stocks are outperforming the S&P 500 index recently. And it's showing us some worrying signs. When the big ones are the only things that are doing well, it doesn't necessarily show us that the markets are very, very healthy. And we saw this in 1999. We saw this in the 1920s and a few times in between. In fact, these are the times that are most notable with this line here that shows us some of those previous periods. And you'll notice it's not super uncommon, but it has been uncommon now over the last 20 years. And when have we seen these readings? Well, have a look at this. Now, if you know anything about stock market stats, you would know that generally stock markets over a period of time are, of course, positive. So if you're getting anything under 68% over even a month, that's usually not a great sign. When we've seen this reading, a week later, the markets have been historically down. And in fact, the next 1 month, 2 months, and even upwards of 12 months have been underneath the stats overall. So it's showing us that there could be a period of weakness coming up, and that's being led by a kind of unhealthy market in this rally. We also know that S&P 500 has shown us a couple of things here when we've seen a percentage of stocks outperforming the index is under 31.5%, which is where we're at the moment. It cuts out a bit of the data, but what it does show us is even worse stats, specifically around that 1 week reading. So this might be something that people are looking at. What are we going to do over the next week? Well, a lot of readings are starting to show us that there should be negativity in the market right when we peak at a high resistance or supply zone. And we'll look at that when we check out those charts a little bit later on together. So here's another stat that's coming through. You can see here again, pretty much chop, and most of the time negative overall for the markets. Now, in previous videos this week, we talked about the VIX dropping hard. It's now dropped even further, and markets have not made new highs. Now, it's a small rally, and the VIX is dropping a lot. When we get these readings, again, the next couple of weeks into the next few months become murky. And that's not what you really want if you're a hard bull right now in markets. Well, maybe you do. You want, of course, cheaper price. We also know that earnings season is upon us. When we've had leads like this is the 14th best lead up to earnings season since the 1950s. And the data stats don't like that. If you again look at this, the next week, we read this last week, the next couple of months, again, very murky for markets. And it shows us that we have to expect kind of potential pullbacks here or even problems in this market because the data and the stats are kind of pointing that way. When we just take the Q1 data from this, it gets even worse. 1 week later, the markets were basically never higher. And then overall, for the next 3 to 6 months, markets really struggled. And these are just the data stats that are coming out, 3 separate ones. And that's not even including one of our favorites at the moment, which is equity risk premium, which tends to increase a lot during recessionary periods. Now, this is less than 2%. No wonder people are starting to make huge moves into cash markets. Basically, money markets are massively hot because it's just not worth being in the S&P 500 for a long-term investor. Remember, these guys are basically looking at it from the perspective of capital preservation. They might have got in on the lows, back in October, December, those types of periods. But right now, doesn't make sense to actually be a long-term holder. Well, generally it does. I mean, most of the time, yeah, the market's awesome to be in. But right now, when you get into these 0.9 to 1.7 readings, we hit this 35% of the time. The annualized returns are almost less than the cash rate. So basically, risk-free money is almost better than the markets right now if you're not a trader and if you're looking at more of those investment things. So a lot of this evidence is kind of damning towards what's going on in the markets right now. And it's something I think we just bring up to mind. Will it make big changes over the next week, 2 weeks, 3 weeks? Well, maybe in this case it will. But overall, what we're trying to understand is what are the bull case scenarios? What are the bear case scenarios? And we'll do a special this week where we'll look at some of the bull case scenarios because there are some. Of course, it's, overall thrust has been very strong and there's a few other things. Some of the right sectors are going bullish and of course the Feds come behind it. So all of these things will come through during earnings season. But ultimately, the markets have to now basically give respect to the fundamentals. We have to see whether they're going to hold these forward PEs. Now, you'll hear me say forward PEs a lot. I want to know what the market believes is going to happen in the future. That is the best economists out there. Now, they may not be correct all at once, but what that does is it gives us a bit of a metric for whether we're cheap or expensive in the markets. And remember, we're trading at the moment about 1.5 times higher than the mean or median for the forward PEs. So I'm not really loving where we are at the moment. We're sitting about 18.6. We really should be sitting around 17 to 16.8 ideally. So we know that Tesla has come out. It's kind of lived up to its expectations of implied vol movements. I love implied vol movements. It shows us what the options market is telling us. And basically, we can then ascertain whether we want to potentially trade those stocks or not. Now, Tesla's down hard. We'll talk about whether it can rally a little bit later on. These are the other big stocks this week. But remember, it's just a little while away now from the biggest stocks. Tech. Tesla and Netflix were the first two. Frankly, both pretty disappointing. Now we find out, what's going to happen with these big tech stocks, the ones that have been leading the market stronger in 2023. Let's now look at the daily moves. You can see here the regional banks had a great movement up, 3.94%. Utilities also came with it. So we're seeing a bit of defensive plays over the last 24 hours. Interesting, because the market sold off and then they rallied back up. So to see defensives and then, of course, a fundamental reason, that could bode poorly if that continues as we hover around this zone. The more the market goes defensive at this zone, which we haven't seen before recently, then the more likely it is that the market's actually about to fall off. Let's have a look at the last 5-day rotation. You can see financials, although they've been lackluster in some returns, overall, very positive towards that section of the market. And again, you can see down here, things like technology, it's kind of sitting in the middle. Communications in particular, only up 0.19. That was a leader up until recently in the markets. All right, let's jump into the charts. We'll start off here with the Russell 3000, which is basically 98% of the market. And this just brings you back to the breadth concept. We were up here back in February, then we fell. Then we rallied again after the Silicon Valley Bank Credit Suisse crisis. And what you'll see here is that there's nowhere near the amount of stocks participating in this rally. That's not good. That's again showing us that there is weakness. RSP is another one that you can use, which is the equal weighted S&P 500, and that can help you quite a lot. We've also had this zone here, and we finally reached it. So I'll give a clap if anyone actually had shorts on the old VIX all the way down to this level. I doubt you did, but 16.37. This now takes us to a low that is not being reached since the 4th of January, since all of this really began. So does this mean that all of the fear is gone from the markets? Well, theoretically, yes, zero DTEs obviously are having an effect on the VIX at the moment, but this is exactly where the bears have to come out of hibernation. We've been waiting for this level. I've had that on the chart for months and months and months, and it finally reached. So I'm expecting volatility to arrive here in the markets, and maybe it's Thursday because we generally see volatility spike into the period of the third week options expiration. Remember, there's trillions at stake, and that's the type of market that you've got to be a little bit careful of because there's a lot of hedging and de-hedging and all sorts of things that go on, and they tends to happen the day before the actual expiration itself. US 2-year. So this is where we've got the disagreement from the market and the Fed dot plot. Basically, if we look out and we go to December of this year, so I'm going to go firstly over here to September, you can see that we're still sitting at 5% now. Now, look how low that got. That was sitting at 3.75%. Now, markets have rallied since then, expecting cuts. That's the whole premise that a lot of people have, plus the Fed balance sheet, which is, by the way, still tapering down. We'll update that in a few days with our custom chart. But overall, we've now seen basically a 61.8 retracement of that initial drop based on Silicon Valley Bank Credit Suisse. Then we've come back up. So now we're sitting at 5%. So the market's starting to realize, well, maybe we're not going to get cuts as fast as we expected to get. But they're still expecting cuts. Here's December, 4.7. Again, it's picked back up, but still expected that not only will the Fed pivot and hold, which I believe they will pivot and hold this year, of course, but then they will cut still multiple times by the end of the year. Remember, it's expected that we're going higher by another 25 basis points. So will that occur? I still think the Federal Reserve will lag behind the market's expectations, and potentially the market will crack it over that concept. Let's have a look at high yield bonds. Now, high yield bonds were down on the session. So that's another thing. The markets ended up pretty much flat, not down very much, though they're selling off a little bit in futures now. High yield bonds dropped. If this keeps dropping, markets keep coiling, markets go into defensive sectors such as utilities and healthcare. I think we know what that means. Not good things. Let's move over here to copper. Copper was looking very negative for a period, and then it recovered by the end of the session. So still not enough information on copper. I'm still negative on copper overall. I think Dr. Copper will show us weakness in the economy. However, we just don't have further triggers. We got underneath this level. We were unable to hold that zone down. So we were unable to hold that 4.05. But at the moment, still making a series of lower peaks or lower highs. So that's, of course, negative for copper overall. Let's move over to the US dollar. So it had a bit of a resurgence. Now, the weekly still points towards, some negativity here on the US dollar. It's back to a critical point for it, basically previous weekly closes. However, we're seeing a massive negative kind of news storyline going on the dollar at the moment. Let's have a look at the daily. Actually, we'll go to the 2 hour and we can see the trend line down. I suspect there are sellers probably around this white line here, which is something I've put in 10221. So it could easily bounce through this and then go down. If we then moved underneath this, I would believe further selling is impacted. Weekly close will be important here. We're also still looking at rallies being sold until we get through probably up here. And that's just because the trend is currently down. But this is a very oversold market. I think the dollar is actually at the harder trade at the moment. Other than being negative on it, it's difficult to be bullish until we start to actually see further signs of bullishness. The reason it's up recently has to be with yields. Yields have increased, so the dollar is more desired. And although everything in the press says it's negative, at this stage, it's kind of what I would call neutral. And I'd still be looking at the overall trend, which is down at this stage. So we're looking for sell-offs. I just got that 10221. Let's move over to gold. Now, gold came down to a 61.8 retracement of the entire pull-up, and it also came back to a pretty good level. It's trading just underneath 2,000 at the moment. Now, we know that in here, between 1975 and 1980, that zone is like the most traded area. That is a very hot level for gold at this stage. And what's happened with gold is I think it's gone kind of made a trend line through here. And you've got a lot of intersection with that point, a lot of confluence. And then we've rallied back up. If the dollar does strengthen, you have to expect gold to start to struggle. And if yields keep going up, gold will also struggle. I was pretty much on the record about a week ago claiming that gold was probably a little bit toppy. And the reason, well, we brought the data up with it. But the reason also is it's tough for gold to get through this zone easily unless yields drop off massively. So yeah, at this stage, we're still looking for further confirmations either way. We do have one switch though, which is towards the negative side. So once we took out this level here, we have to now believe that rallies are going to be met by sell demand. So we're coming up into some supplies. I've got a 61.8 retracement here, which is about 2020. So I'm kind of looking more, do we get something sell-offing in here? I don't think they're high statistical trades, but both of these levels in here are where I'd be looking for, rejection kind of signs from gold. Yeah, we'll come back to that chart when it gets more interesting. Natural gas continues to fall off. Good. We want that to come back and do a gap fill. No real other reason there. We're looking for kind of like this at the moment for natural gas. Do remember natural gas is it's called the widowmaker for a reason. It is a very dangerous trade and it can move upwards of 30% on the day. So you've got to be careful there in those kind of futures markets. Let's look at oil. So oil fell through that magical low and it's starting to look like this whole thing was a false break, which we kind of assumed it may be. I did think we'd find further buying here and kind of move like that and then sell off. From the scalp side, that didn't happen. It didn't actually eventuate, which I'm kind of surprised it didn't. But it's fallen straight back off. Now we're looking for pretty much continuation shorts, something around 80.36. If it does come back up to that zone, that is it's not very stacked, but it's pretty stacked level. You've got supply now, which we know is there. You have, of course, the most traded zone. You've got a fib overlay from that pull. So there's a bit to like about shorts in this area. I think that oil is looking kind of negative. It's demand destruction in play, and there is a gap underneath here as well. I think it might be down to 76, which is where that whole narrative came out with OPEC kind of cutting. Now, I never believe in the OPEC rallies. It's pretty consistent. I've said it for a while. I always think it's false, and it tends to be, and you usually get those kind of fills. But at this stage, oil, if it holds these weeklies down, is basically telling us that this could be a false break and that actually oil is going back down into maybe the middling 60s over the next coming months. Let's move over to Tesla. So post-market price was pretty bad. I don't know where it exactly ended, but I wrote it down here for the recording, 169.41. So it's right on the expected options lows. Now, what expected options highs and lows are is where markets are going to hold 68% of the time. This is not a great sign for Tesla. Now, to be on the expected market options low, if we do see a rally in the markets, you could see Tesla come back up to this zone quite easily. And if it did instantly come back up, then that would be probably a strong sign because it would hold this level here with this 176.20. But all things being equal, it's kind of, I think, a pretty negative result for Tesla, though I'm not an expert on the fundamental side of it. I do know that this zone is something I've looked at for a while. So that's that 145 gap fill. So I've said that for a long period through this. I kind of said that I believe it's coming there. We got the initial rally off the demand. We've seen that one kind of false breakout, but generally this level be very strong towards shorting. And I'd like to see it back at 145. I mean, that's just the way that I believe this market should go. It should fill that gap. And if you think about it, that would also basically 61.8 us. So it's a fair level to believe that the markets get to. Now, Tesla will only fall down there if we continue to see weakness in the market as well. That would be a big sign. But yeah, maybe some relief in the session. A lot of people love to buy the dip, so we might get some relief and we could do something like this. At least that's my kind of leading theory at this stage on Tesla. We'll come back to it. Options theory would tell us that we can't really go lower than 150. If we refresh this, so you can see where the puts and the option calls are this week. You can see 150, 160s. We're currently trading at 169. So it's quite easy for the market to drop further on Tesla and, you know, go into these kind of levels. And overall, anywhere between here is definitely smiley face for the market makers out there with options coming in. 709,000, not a huge Tesla week, but certainly bigger than some of the normal ones recently. Let's move over to Apple. Now, Apple did break out. So if this is a double top, basically it's got a higher high on it now. If we now go underneath this, I'd mark in 160. Because if we see 160 break, so let's say the market's come back down and close 160 low, I feel like that's probably going to be a double top with the false break higher high. And at that point, markets are actually looking very bad. And I think swing traders will come in towards the short side. Now, at this stage, of course, it looks strong coming to earnings season. But we know that Apple tends to do this. You know, here's the runs, here's earnings season. You can often see that Apple loves to buy the rumor and then it loves to sell the fact. And that's kind of the stats that we showed at today's video. So Apple right up here, definitely still bullish looking. It's coming through the top of that trend line. Of course, I curve fit the trend line and claim that oil, you know, can easily go to here. Absolutely. That's the problem with trend lines sometimes. But let's go through some others here. Amazon, you can see it's coming up to the critical zone. Could this be a double top with the higher high on the side? Microsoft, take a look at that, consolidating. Google, if we have a look at Google, consolidating at these resistances. Nvidia, consolidating at these levels. So it's not just one tech stock. XLC, we look at communications. If you load that up, it's consolidating at these levels. So everything is sitting here, and maybe it's Tesla that's the straw that break the camel's back, but maybe it has to be the earnings of the big tech. We just don't know. The markets are very resilient at the moment. They keep sucking in new buyers. Each time it drops in the morning, each time it kind of rallies up. What you should almost be more concerned about is a rally in the morning, which tends to be faded by the afternoon at this stage. Whatever the futures market's doing usually is wrong, though I suspect increased volatility coming into this third week options expiration. As we know, if we suck back the equal weighted ETF of the markets, it's nowhere near as high as it was. This is, again, just showing that this rally is more of a false rally, more likely, based on the strength of the overall market. It's just not as healthy as, you know, people may think. If we go over to regional banking ETFs, you can see here they're starting to show signs of potential base formations. I'd like to see it do this personally. And I've got alerts sitting underneath 41.38. But yeah, a little bit of recovery here over the last 24 hours, up about 4%. The DAX doing nothing. Anywhere between 15,900 and 16,000 is where the next resistances are. but there's nothing to be concerned about. I mean, there's no signs of weakness yet. It's just where resistances are. The XJO, the Australian market, that's just trading right around these highs. Again, no real strong strength of turnaround here. If copper fails, though, expect the XJO to get hit. Copper really smashes a lot of the Australian market for any Australian viewers out there. Let's move over to the best markets now. We'll go over to the US 2000. And we know that the US 2000, 1810, I've said it many times before, we've currently got a series of higher lows. Do we actually breach that? So we've got the most traded zone down here. This is where I believe buyers, if the dip does occur, buyers may commence on Russell 2000, and that would be similar on the S&P. But if we take kind of like a trend line behind the back here, or even pull that all the way back through these zones, you can kind of see that it is still making a series of more over higher peaks. I'd like to see that get taken for bears to start to regain control of this market. Big weekly close. Take a look at the weekly here. You can again see that the rejection's up at this high. It's all about where this thing closes. Qs, drops, comes back. At least it filled the gap, so there's no gap fill anymore there. Still got the gap fills below, so still have a lot of inefficiencies down there. Still no breakout to the top side. Is this an almighty double top? Well, we'll soon find out. Obviously, we know where the critical breaks are. I think you can spot that if you've been trading for a while. Here is the overall futures. You can see it came back up, tested into this zone, sold off. Lots of wicks, lots of dojis. It doesn't even know what it wants to do. The market is so neutralized right now. It's really waiting for a catalyst. And I thought Tesla might be a catalyst. Possibly it's going to have to be the third week options expirations, though. Let's move over to the S&P 500. You can see the expected weekly options highs. We're basically trading around those. Again, this is where you would usually see sellers recommence. SPX, you can see here again where you'd see sellers recommence. Depending on how I curve fit this trend line is basically sitting right on current price. And if you look at the US 500, now this is where things get a little bit interesting. So many dojis. But if we actually break down the markets, a little bit more negativity here. So we have the trend line down. Okay, got snapped yesterday. It's going to come back up and retested it. And we have that high. Well, we've got kind of like a high in here. We've got lows. We've got higher highs. And then we have this switch here. So we've got a high low in there. Then we've got a lower low after a higher high. And that one went and obviously trapped in, I think, quite a few stop loss hunts and quite a few orders. So as it went down, the markets then came back up. This was an unfilled gap left over. It came and filled this zone. The bears really got to push this thing down. I mean, they got to get it through here at least. I'm going to set alerts underneath this zone, 4124 kind of level. You need a new low. I can see why shorters are here. Absolutely. But this market needs to sell off now. And I know I've said that quite a lot. It's been a very boring period here. There's actually been some good little trades for scalps, but overall, volatility surely is set to rise into this third week options expiration. If the market does go down, where are the bulls going to be? It's got to be between 4,100 and 4,090 that they initially charge. Very heavily traded zone in this range, 4,100 flat, and 4,089 or 4,090 is a fill gap. So if bears take control, I think bulls somewhere in here. And at the moment, I just think like every other day, it's been mostly sitting on the sell zone straight away into these market opens. So yeah, and they have been working. I mean, the markets have been selling off from these levels we've been talking about, but these are the zones that's there. If you're a bull, you just want a daily close. Just give me a 4180 daily close. So I know that every rally that comes back or every dump that comes back, I can basically look towards the bull side. Let's move over to the options expiration. This is where the billions and the trillions are expiring. So we'll look at the 21st. You can see here almost 3.5 million units now. And maximum pains continues to be much lower than the market. Now, this is the only week you usually use it. We're sitting at 412.94 at the time of this recording. And 404 is basically where the market is expected to give maximum pain. So it's got some downside risk on it here coming into the Friday options expiration. Now, if you're a believer that crypto rules the world in terms of the markets at the moment, in terms of forward volatility, crypto, look, this one was actually trading perfection. We love the short here. We love the short here. We even like the bull side to the short here. So this has been very nice. And I expect crypto to drop further. I kind of think like maybe like this. And this zone here will be a pivotal test for it. I would say there's buyers somewhere around that 28,000 zone. It's a very heavily traded zone. We get fib pullbacks over the move, and we've also got some beautiful demand in there. So whether that then takes the low first, so kind of like does this, I don't know. But I would expect crypto to see further weakness. If rallies come through 29,200, that kind of area, I could see structure in here as well from the potential technical side. Great chart. I knew it was going to be good, and it has been so far. It's really presented. When it got to 30,200, I love that zone so much. And it's the first time in a while I've actually really enjoyed crypto a lot. So crypto's been awesome. And I mean, maybe if you're bull, maybe it hasn't been awesome. But, you know, overall, we're coming back down to levels where you could see bulls recommence. And at the moment, the case is going to be that resistance of the structure here becoming support. I'm not sure that's enough. I think it goes a little bit lower first. But look, that's my opinion on crypto. We'll see what happens. Over Thursday, unemployment claims, 8:30 a.m. New York time. Then we go to flash manufacturing and services PMI, which is Friday, April 21st, 9:45 a.m. New York time. Bit of information coming out from the Eurozone as well, which we'll need to be on top of. And do remember, if you enjoyed today's video, why not consider subscribing, smashing that like button, coming over and viewing us on the other networks. Of course, coming and joining our Twitter would be great. And then if you're interested, you got some free trading cheat sheets as well. Thanks so much for joining us today, guys. It's going to be a hopefully increased amount of volatility, which gives us all opportunity. And the markets have been, I would say, lackluster in stocks, though there have been some great picks. And the crypto market's been on fire. All right, catch you for now. Bye.